And welcome to today's webinar, Should I Refinance My Student Loans? I'm Julie, and I'll be today's moderator. Before we get started, I'd like to go over a few items so you know how to participate in today's event. We've taken a screenshot of an example of the attendee interface. You should see something that looks like this on your computer desktop in the upper right-hand corner. To expand or collapse your control panel, click the orange arrow button. You're listening in using your computer speaker system by default. If you would prefer to join over the phone, just select phone call in the audio pane and the dial-in information will be displayed. All attendees are muted for today's webinar. Click the handout arrows to view or save the documents from today's webinar. And to ask questions during the meeting, please click the question arrow and type your question inside the panel box. You may send in your questions at any time during the presentation. We will collect all the questions and address them during the Q&A session at the end of today's presentation. Now I'm going to turn the webinar over to your presenter, Robin Lind. Robin is the Credit Union's Education Coordinator and Manager of the Student Credit Union Program at Northwest and Colerain High Schools.
Thanks, Julie. Hello, everyone, and welcome to today's webinar, Should I Refinance My Student Loans? I'm Robin Lind from COP-FCU, and I'm looking forward to sharing some great information with you today. You just heard from Julie Dudley, our CFO, and also joining us today is Julie Klepak, our Business Development Representative. As Julie mentioned, all attendees are on mute at this time to eliminate background noise, but I do encourage you to ask questions through the chat window, and Julie will be keeping an eye on that for me throughout the webinar. This webinar will be recorded, so you will receive an email with a link to view it again. And you can watch the recording of this and all of our other webinars anytime at our website at copfcu.com/webinars. Before we get started, I want to talk about some recent changes that have impacted many borrowers due to the COVID-19 pandemic. In March of last year, as part of the CARES Act, Congress put in place several relief measures for student loan borrowers, including suspending student loan payments, ceasing collection measures on defaulted loans, and cutting interest rates to 0% temporarily. Now, these measures were supposed to be in effect for 60 days, but as the pandemic has gone on, Congress has extended these measures. The actions apply to federal student loans, including direct loans, FFEL program loans, and federal Perkins loans, whether or not they're in default, and they even apply to direct unsubsidized loans for students who are currently in college. So they've been extremely helpful for students during these times. Now, these measures do not apply to private student loans, however, because the Department of Education doesn't have authority over private student lenders. Payments were supposed to have resumed last week on January 31st, but the measures were recently extended again, and at this point, there is no end date. I have heard that they're going to wait to reinstate payments until after the April 15th tax filing deadlines, so that people can use their 2020 income to determine any income-driven repayment plans, which would account for any job losses or loss of income that may have occurred due to the coronavirus. But that's just speculation at this point, so we're not really sure when the payments are going to be reinstated. Now, the CARES Act and these student loan relief measures are continuing to develop, so I'm not going to go into any more detail about it right now. However, if you have federal student loans, please make sure you visit studentaid.gov/coronavirus for the most up-to-date information. This website is excellent, and it goes into a lot of detail about how to take advantage of these measures and which loans qualify. It's critical to check into this because this information might have a significant impact on whether or not you decide to refinance your student loans right now. Because when you refinance a federal student loan into a private student loan, you lose any current or future potential federal student loan benefits, including the ones that we mentioned here. So it's a great example of how there are always a number of factors you need to consider before you refinance. So if you have student loan debt, you are definitely not alone. According to the 2019 student loan statistics, there are almost 45 million student loan borrowers, and collectively they owe $1.5 trillion in debt. And this doesn't include the estimated $119 billion of private student loan debt. So it's easy to see why so many people are interested in student loan refinance. At the very least, it can make your life easier by consolidating multiple loans into one monthly payment, and hopefully you'll be able to save some money. But while refinancing is a good idea in many cases, it's not always the best idea for everyone in every situation. So in this webinar, we're going to explore the pros and cons of refinancing and hopefully shed some light on what's best for you. So let's start with a question. Why are you considering refinancing your student loans? Are you hoping to lower your monthly payment? Do you want to pay less interest over the life of the loan? Are you hoping to shorten the number of years that you're going to be paying on the loan? What was it that brought you here today? You can type your answer in the comment box as Julie showed you. And while we're waiting for the answers to come in, we'll go ahead and talk about what we're going to talk about in today's webinar. First, we're going to talk about what factors you should consider when thinking about a student loan refinance or consolidation. We'll cover the pros and cons and how to weigh them so that you can make the right decision for yourself right now. And it's possible that after this webinar and some more research that you'll realize that maybe refinancing doesn't make sense for you right now. But maybe it will in a few years, so it's always an option to refinance down the road when it makes more sense for you. Next, we're going to talk about what type of student loans you have, federal or private. Does your loan have fixed or a variable interest rate? And what is your loan term? These are all going to be important factors in determining what's best for you. Next, we'll talk about what refinancing options you have and how to choose the best one. Then we're going to talk about borrower requirements and how to know if you're eligible. These requirements are going to vary depending on the type of loan you decide on and the financial institution you're working with. So it's something you'll need to know before you apply. And then finally, we're going to look at some real life scenarios of what refinancing and consolidation can do for you. Now, there are a lot of good reasons to refinance, but as with any financial decision, it's critical to think it through carefully and consider all aspects to make sure that you're making the right decision for yourself right now. So here are some factors you'll want to consider when you start the process. First, what is your main objective with refinancing? Do you want to pay off your loans faster? Do you want to lower your payment? Do you want to lower the interest that you're going to pay? Or do you just want to consolidate your loans so that you only have one payment? Now, I'm seeing that these are all things that you've mentioned in response to my question a few minutes ago, and these are all going to be important factors. If you want to lower your monthly payments, you could look for a lower interest rate and lengthen the term of the loan. But if your goal is to save money on interest you'll pay and you can afford a higher payment each month, you could shorten the term on your new loan, maybe go from a 15-year to a 10-year. That would probably raise your monthly payment, but it could significantly lower the amount of interest you'll pay and save you money over the life of the loan. So knowing exactly what your objective is going to help you decide what's right for you. Another important factor is what type of loans do you have? Both federal and private student loans have pros and cons that are important to consider before you refinance. It's possible that you'll only want to refinance some of your loans, maybe only your private loans, so that you can continue to take advantage of the options offered by your federal student loan. Next, you're going to want to think about what is a manageable monthly payment for you. Having a clear monthly budget will help you choose what is your best refinance option. There are a lot of good student loan refinance calculators out there. NerdWallet has a good one, and you can go in and you can put in different factors like different payment amounts, different rates, and different terms to see what's going to work best for your budget, and that'll help you know what you should be shopping for in your refinance. Another important factor is, did you graduate from college? A lot of student loan refinance servicers require that you have earned a bachelor's degree from an accredited college, and most don't allow refinancing until after you've graduated. So that might affect your decision as well. And finally, are you planning to go back to school? This is another huge consideration. Most private loans won't let you go into forbearance if you decide to go back to school, so you might want to hold off on refinancing if you do plan to go back. So first we need to take stock and figure out if you have federal or private student loans. For federal student loans, you're going to need to visit studentaid.gov. To log in, you'll use the FSA ID and password that you set up when you filled out your FAFSA, and you can create an account to see your student loan portfolio. Once you're logged in, you should see a dashboard that will show any federal student loans you may have, as well as any federal student aid that you have. Now, once you're in studentaid.gov, what is it that you need to know? Whether you're planning to refinance or not, you'll need to know what is your current balance and your repayment term. Your repayment term is going to be a big factor because you'll want to know what payment plan you're on. Are you on the 10-year standard repayment plan? Are you on an extended repayment plan? Is your plan income-based? It's important to know what you're working with so that you have a better idea of what you would want in a refinance. Also, excuse me. Also, if you're in repayment, how long have you been in repayment? And when is your loan due to be paid back? You'll also want to know what your interest rate is. Obviously, if you have a pretty good rate right now, it might not make sense to refinance. Another question is your loan subsidized or unsubsidized? As you probably know, if your loan is subsidized, the interest is being paid by the Department of Education as long as you're enrolled in school at least half time. But unsubsidized loans start to accrue interest as soon as the loan is dispersed. So you probably don't want to refinance subsidized loans if you're still in school or if you plan to return to school. You'll need to know also what your monthly payment is and whether that amount works for you. If not, you might want to refinance to lower the payment. But if you could pay more, you could shorten the term when you refinance. And finally, you'll want to know who your servicer is. These are all things that will play a part in your refinance and what you're going to want out of your refinance. Oh, shoot, I'm sorry. It's also important to know the benefits of your federal student loans. Now, this here isn't a comprehensive list. Remember the benefits that we just talked about from the CARES Act, like suspending loan payments, ceasing collection measures on defaulted loans, and cutting the interest rates to 0%. More typical benefits are listed here, including the ability to defer your federal loans up to 3 years in some cases, and subsidized loans may not accrue interest when you go into deferment. Another benefit is that your loans can be discharged for death or disability. And with your federal loans, you have different payment options, so you can do it on an income-based plan. There's also a default rehabilitation for anybody whose loans are in default. And you may be eligible for forgiveness programs. There are a few different versions of student loan forgiveness programs, but honestly, student loan forgiveness could be its own webinar topic, so it's really too complicated to go into right now. But if you have any questions about student loan forgiveness, please feel free to contact me and I can tell you more about it. If you have private student loans, there are a few places you can check if you don't know who your lender is there. First, you can check your university's financial aid office. You can contact them and they should be able to look it up for you. They might not have the information right away, so they might have to research it and call you back. Another great resource is to pull your credit report at annualcreditreport.com. It's a good idea to pull your credit report once a year anyway, and you're going to need it for other reasons that we'll talk about later. So this is a great resource. You can get one free credit report from each of the credit bureaus every year, and those are listed here: Experian, Equifax, and TransUnion. So go ahead and get all three and compare them to see what student loans you have, and it should list who your lender is there. You'll want the same information from your private loans as from your federal loans. And the benefits for your private loans are going to vary by the lender. Some loans allow any co-signers to be released from the loan after a certain number of on-time payments. And most lenders do give a rate deduction for setting up automatic payments, usually about 0.25%. And some lenders do offer forbearance options, but they're not usually as robust as the federal loan forbearance options. Now also, and this is where federal and private student loans differ greatly, you can usually refinance private loans as many times as you want, unlike federal consolidation loans. So if interest rates go down or your income goes up or your credit score improves, you can refinance to get a better rate. So let's talk about what's the difference between student loan refinancing and a federal student loan consolidation. With a student loan refinance, you're taking out a new loan that is going to replace some or all of your existing student loans. So your new lender is going to pay off your existing loans and then you're going to owe the new lender instead. The pros of that are, first, you can usually lower your interest rate, which is generally the main reason you would refinance. And that can lower your monthly payment and save you a lot of money on interest over the life of the loan. You get to select your own lender, so you have control over the interest rate and the terms that you'll accept. Also, you can refinance both private and federal student loans in a student loan refinance, including Parent Plus loans, as long as they're in the name of the student that benefited from the loan. In most cases, parents can't refinance their own Parent Plus loans in their own name. Now, the con to a private student loan refinance, and it's a big con, is that you will lose any federal student loan benefits you may have. With a federal student loan consolidation, on the other hand, you're just combining all of your existing student loans into one loan. With a federal consolidation, you can only consolidate federal loans, unlike private student loan refinance where you can refinance both. So with a consolidation, all they're going to do is they'll just roll your current loans together, and you're just going to have one payment to make each month. Now, the benefit to consolidating your federal loans is that you go from having 2 or more loan payments to just one, which can definitely make your life and your budgeting a lot easier. And you can also take any variable rate loans that you have and switch them to a fixed rate. And you'll still have access to the federal student loan benefits that we've talked about a few times, income-driven repayment plans, loan forgiveness programs, and forbearance options. So unlike private student loan refinancing. But there are some cons to federal student loan consolidation though, and some of them are pretty significant. First, a direct consolidation loan will not lower your interest rate, and it won't generally save you money. You'll have a fixed interest rate for the life of the loan. So in that fixed interest rate that you're going to get is the weighted average of the interest rates of the loans that you're consolidating, rounded up to the nearest 1/8 of 1%. So you might actually raise the interest rate on some of your loans. And there is no cap on the interest rate of a direct consolidation loan. Also, what happens with a federal student loan consolidation is that you do get a lower monthly payment, but it's usually because you've extended the length of a loan. So you will be paying less each month, but for longer, so you could actually wind up paying more in interest over the life of the loan. And finally, you can only consolidate your loans once, except for a couple of rare exceptions. So once you have a good idea of what you want, what your budget is, whether you're going to go back to school, what your current rates and terms are, you should have a better idea of which one of these is going to work better for you. If you decide that a federal consolidation is right for you, if you've decided you might be going back to school, or you might need those forbearance options, maybe your job is a little bit more precarious, you would go to studentaid.gov to find the details about the loan and apply. Your lender is going to be the U.S. Department of Education. As I mentioned, your interest rate is going to be the weighted average of all the loans you're consolidating, rounded up to 1/8 of 1%. So you're probably not going to get a lower rate. Depending on your current balance, you'll get a 10 to 30-year repayment term. You'll have flexible repayment options to choose from, like you do with your current loans. As we mentioned, you can only consolidate federal loans and only in the borrower's names, and your loan may qualify for education tax benefits. If you decide on a private student loan refinance, once you know what you want, you can start researching lenders. A good place to look for lenders is obviously your local credit union. If your credit union doesn't offer student loan refinancing, they should be able to point you in the right direction. You could also call the financial aid office at your college or your university to ask who they recommend, or you could ask your current loan servicer to see if they offer refinances. Now, once you've decided on a student loan refinance, you'll want to compare each lender's interest rates and terms, as well as their borrower requirements. To find this information, you'll have to visit each lender's website. You can search under rates. They should have a rates tab, and they should have a page that gives you all of the fine print and also a place to apply. With a refinance, you're going to have an option of a fixed or a variable interest rate. Ideally, your rate should be lower than what you have now. And there will also usually be a variety of terms, anywhere from 5 to 25 years. You can refinance both private and federal student loans, and you can refinance Parent Plus loans as long as they're going to be in your name. And again, you may qualify for education tax benefits. Now, it's important to note that if you apply at several different lenders around the same time, it's only going to show on your credit report as one inquiry. So don't be afraid to shop around for the best rate. And this goes for all kinds of loans. In the future, if you're shopping for a car or for a mortgage, similar credit pools that occur within a short time frame all show as one pool because they show that you're just shopping for a rate. Now, this doesn't work for credit cards, however, just for loans for major purchases like student loans, cars, mortgages. So now let's talk about the borrower requirements and eligibility. First is, as I mentioned before, most lenders require that you have earned a bachelor's degree from an eligible school. The reason for this is lenders want to make sure that you've completed a program from a school that prepares their students for gainful employment. So the Department of Education has developed a list of schools called Title IV schools based on their gainful employment rate to make sure that grads can reasonably repay their loans. Next is, do you have good credit? Obviously, your credit score is going to be one of the main factors in any loan. Most lenders require that you have a credit score of at least 650. Most also want you to have an established credit history of at least 3 years and to have at least 3 trade lines on your credit report. Now, this could be a car loan, your current student loan, a cell phone, a credit card, or any other line of credit, or if you have a personal loan. They just want to see that you've had some credit already and that you've managed it successfully so far. Now, this is another great reason to get your free credit report from annualcreditreport.com. If possible, also, it's a great idea to get your report at least 6 months before you're planning to refinance so that you can make sure that everything is correct. Keep in mind, when you get your free credit report, it's not going to give you your credit score. That actually costs money. So your free credit report is just going to list all of your loans and all of your credit information. But credit reports are not always correct. We see it around here fairly often. So if you get it ahead of time, you'll have time to dispute any inaccuracies and get them corrected before you apply. The next requirement is, are you employed? Most lenders require that you have 24 months of continuous employment. Most also have an income requirement. They may not publish it, but it's usually somewhere around $36,000 a year. Now, your employment doesn't have to only be with one employer, just 24 months of continuous employment. The lender just wants to make sure that you're capable of holding a job and you're going to be able to repay your loan. Now, closely related to that is, are your finances stable? Now, this is more of a personal requirement for you. Are your finances stable enough that you're going to be able to repay your loan? Because once you give up your federal loans, you're going to lose some of the protections and the options that you have that could help you if something happens, like if you lose your job or if you decide to go back to school and your income is going to be cut. The next one is, do you have a good debt to income ratio? Your debt to income ratio, or DTI, is how much money you owe versus how much money you make. They're looking for what percentage of your monthly income goes into paying your debt minimum payments each month. The required DTI varies depending on which lender you choose, but most lenders want it to be less than 50%, and the lower the better. And finally, your loan balance. Most lenders will finance a minimum of $5,000, and most have a cap on how much you can refinance, usually up to $125,000. Now, after hearing about some of the borrower requirements and eligibility, if you don't qualify right now, don't panic. There are some options. First, you could get a co-borrower. If someone in your life has good credit, it can help you get the loan that you wouldn't otherwise qualify by yourself. If they're willing to co-sign, it can help you get the loan, and it can even help you get a better rate than what you would have gotten on your own. But keep in mind, though, that both you and the co-borrower should think long and hard before you go through with it. Co-signing on a loan is not a small thing. By co-signing, that person is saying that they're willing to pay off the loan if you can't or don't pay it off yourself. So it's a huge potential financial responsibility they're taking on, especially if you have a high balance on your loan. And it's always tricky to introduce money into personal relationships and can really strain your relationship if anything goes wrong. So be sure that both of you understand the risks and the repercussions of them co-signing on the loan. Now, of course, there's always the option if you're going with a private student loan refinance, you could always refinance again down the road when you're more financially stable. So you could write up an agreement with your cosigner that you're going to refinance again without them on the loan in X number of years. But until that happens, they're going to be on the hook for the loan as much as you are. And also, if you don't qualify right now, that doesn't mean you never will. So maybe you don't have a 650 credit score right now. So take some time, maybe a year or so, to really work on your credit. The most important thing is to pay all of your bills on time, every time. You should also work on lowering your DTI. So if you carry a balance on your credit cards, make a concerted effort to pay them off, which is going to lower your DTI, and it's also going to lower your available credit usage, both of which are going to improve your credit score. So that way, you can work on your credit, and that way you're building your credit score in the meantime, and then you'll have more options open to you in the future. So let's talk about a few examples and see some different scenarios and what's going to be the best option for each one. So in our first example, Sanjay has a loan with a $25,000 balance and a variable interest rate that's currently at 7%. He has a 15-year term, and if he keeps this loan, he'll wind up paying a little over $15,000 in interest. So here's what would happen if Sanjay found a lender that had a 5% fixed rate with a 10-year repayment term. You'll see that his loan payment will go up $40 a month, but by paying an extra $40 a month and shortening his term by 5 years, he's going to save almost $9,000 in interest. So in this case, refinancing is definitely a good idea, assuming he can pay the extra $40 a month. In our next example, Anita and her parents have almost $95,000 in federal student loans with interest rates between 6.8 and 7.9%. Their loans include 3 direct loans and 2 Parent Plus loans. They've been in repayment for 2 years and have 8 years left until maturity. And their main objectives with refinancing were to lower their interest rate, lower the term of the loan, and to remove the parent's responsibility from the Parent Plus loans. So we know Anita is on the 10-year standard repayment plan since she's been in repayment for 2 years and has 8 years left on her loan. So with her current situation, she pays a little over $1,300 a month. And if she keeps this loan, she's going to wind up paying almost $31,000 in interest. With her new loan, she was able to find a variable rate of 3.45%. She reduced her terms to a 5-year loan, and you can see that her payment went up a little over $400 a month. But you can see that by shortening the term and lowering her interest rate, she's going to be able to save over $22,000 on interest. Now, obviously, this is a very high monthly payment, and not everyone can do this, but you can see that by paying more per month and shortening the terms, you can really save a lot of money over the life of the loan. Next, we have Mia. Mia has almost $30,000 in federal subsidized student loans with interest rates between 3.6 and 61.25%, and a little over $2,500 in private loans with interest rates between 3.5 and 4.72%. She has just entered repayment, and she is planning to return to graduate school next year. Should she refinance? No. After talking to her lender, Mia decided not to refinance. Remember, we've talked about the ability to put your federal loans in deferment if you go back to school. So while Mia is back in school, she's going to be able to defer her loans while she's in school. And since her loans are subsidized, they won't be accruing interest while they're deferred. So that's great. And she's also lucky enough that she is able to defer her private loans while she's in school as well. Now, not all private loans offer deferment, so this is a great perk for her too. Private student loans are not subsidized though, so her loan will continue to accrue interest while it's in deferment, but the rates on her private loans are fixed and they're very competitive, so she decided not to refinance at this time. So once Mia graduates from grad school, she can always come back and look at all the factors again, and she might decide that refinancing is a good decision at that time. But for right now, it's better to just keep the benefits of her current loans. And last, we have Michael. Michael has a little over $32,000 in federal student loans with interest rates between 3.6 to 6.125% and a little over $3,500 in private student loans with interest rates between 8.25 and 10.5%. He has also just entered repayment, and his main goals were to lower his monthly payments and lower his interest rates. Now, there's a lot going on here, as you'll see, but it's a great illustration of the different options that you have for different loan types and good uses for both refinance and consolidation loans. So with Michael's current loans, he pays $344 a month on his federal loan, and he will pay almost $9,000 in interest over the life of that loan. And he's paying $342 a month on his private loan and will pay almost $40,000 in interest if he keeps his current terms. So what Michael decided to do, because one of his main goals was to lower his monthly payment, was to do both a federal student loan consolidation and a private student loan refinance. So first he did a federal consolidation loan on a 20-year repayment plan. So that is the extended plan. And with that plan, his monthly payment went down a little over $100 a month. Now you'll see that his total interest will be almost $10,000 more over the life of the loan, but it did lower his monthly payments, and that's what his goal was. And then for his private loans, he refinanced for 15 years at 6.25%. So he shortened his term, and he still managed to have his monthly payment go down $40 a month. And he cut his total interest over the life of the loan by almost $20,000. So he's still saving almost $10,000 overall in interest over the life of both loans, even though his interest went up considerably on his federal loan. And his monthly payments went down $171 total, so his payments are going to be a lot more comfortable for him. So it's paramount that you're able to make your payments each month. The last thing you want is to have a bunch of fees for missed payments or to go into default. So sometimes it's better to extend the terms, at least temporarily, to make sure that they're manageable. And Michael could always refinance his federal loans down the road when he's in a better financial position. Or as he makes more money, he could just start overpaying them to shorten the life of the loan and lessen the interest he'll pay. Now, one thing to note, if you do overpay your loans to pay them down faster, make sure that that money is going to the principal and not toward your next payment. Loan servicers are all different, so you'll need to make sure you set these up the correct way so you're digging into the principal when you make your overpayments. I know for Nelnet, you have to call them and tell them what to do with any extra payments. So it might make sense to make extra payments as a lump sum so you don't have to call them every month. I think, as far as I know, Navient makes it a little bit easier. If you schedule an extra payment or overpayments, you can just specify what loan it should go to online. And generally, obviously, you're going to want to direct any extra payments to the loans that you have with the highest interest rate. So a quick recap on a few key factors that I want to make sure that are your takeaways. You should consider refinancing if you have high or variable interest rates. Rates have been at record lows for a while now, so chances are you can get a better rate and you can get a good fixed rate. You never know what's going to happen with interest rates, and it's hard to imagine they could go much lower than what we have now, so it's definitely worth checking out. Good credit is another factor. It's always better to have the loan in your name if at all possible. As I mentioned, money can really complicate relationships. So if you can't do it on your own yet, you might want to wait until you can. If you have several different loans, refinancing or consolidation can certainly make your life easier, and it'll make it easier to budget when you're only making one payment. And if you only have private student loans and you can find a better rate, you really don't have anything to lose by refinancing, since private loans aren't eligible for federal student loan programs. Now, you should think twice if your finances are not rock solid. As I mentioned, federal student loans offer a lot of benefits that private loans don't, including loan forgiveness, generous deferment and forbearance options, and maybe some things that haven't even come out yet, as we learned with the CARES Act. So if your job is seasonal, or if it's precarious, or if there's a concern that you might not be able to make your payments at some point, private loans are generally much less forgiving than federal student loans, and you probably shouldn't refinance to a private loan unless your finances are solid. So if you only have federal loans right now, while loan payments are suspended and they're not accruing interest due to the CARES Act, it's a great time for you to get your financial house in the best shape possible. So build your emergency fund, pay off any high rate debts, and work to improve your credit score. And that way, when the smoke clears and payments restart, you're going to be in a much better position to get the best refinancing rate possible if you do decide to refinance down the road. And if you're eligible for student loan forgiveness, you really should think about that before you refinance. Now, typically in our webinars, I do not talk about things we offer at COPFCU, and we're running short on time, but we really do have a great student loan refinance program. So if you're thinking about refinancing, please either contact me or one of our loan officers, and we also have a lot of information on our website. So hopefully this was some good information that you've learned today. So now I'm going to open it up for questions. And while I'm waiting for those to come in, I wanted to let you know that we do have another webinar coming up on February 24th called Couples and Money. Money can be a very hot button issue with a lot of couples, so we're going to talk about how to get on the same financial page and talk about money so it doesn't sabotage your relationship. And we also have a first-time home buyer webinar coming up on March 24th, where we're going to talk about mistakes to avoid when you are buying a house for the first time. And you can register for both of these webinars at copfcu.com/webinars. Now, we did have a question about what is a good student loan refinancing rate. And it looks like now it looks like for a fixed rate, it ranges usually from 2.8% to 6%. The highest I saw was 8.28, and I think the lowest I saw was 1.99. And then for variable, I've seen as low as 2% to the high fives and the low sixes. So, you know, obviously this is going to depend on your credit score and other factors that we talked about, you know, but it looks like for A+ credit for fixed, it's usually about 2.8 and 2% for variable. And then we also had a question about student loan forgiveness for law enforcement officers. Somebody had asked if they should wait to refinance. And as I mentioned before, student loan refinance is a very complicated topic with a lot of factors involved. So I do have your email address, so I will contact you later this afternoon and we can get together and talk about that a little bit more detail. Julie, were there any other questions that came in?
No, Robin, at this time, there are no other questions.
Okay, great. All right, well, as I mentioned earlier, this webinar was recorded, so you should receive an email with the recording in a few hours. And you can also access it and all of our other webinars on our website anytime at copfcu.com/webinars. I appreciate you joining us today. If you have any questions, please feel free to email me or call me anytime. And if you have any suggestions for future webinar topics you'd find useful, please let me know. I'm always looking for great topics to cover. So I hope you found this information useful. We appreciate you joining us, and I hope you have a great day.